Hey everyone, welcome back to the channel Learn ICT with Kiki. In my last video, I explained what liquidity is and where it forms in a market. We talked about liquidity above swing highs, below swing lows, equal highs, equal lows, and along trend lines. That video was meant to answer one question only: what is liquidity? But now that you understand what liquidity is, the next question naturally becomes: how do we actually use liquidity to enter trades? And that's exactly what this video is about. In this video, I'm going to explain why we do not enter at liquidity, what we wait for after liquidity is taken, and how displacement acts as confirmation before entering a trade. By the end of this video, you should clearly understand this idea. We wait for liquidity to be taken, then we wait for displacement, and only after that do we look for an entry. Once liquidity is taken, something important happens. The market has completed its objective. The orders that were resting at that level have been filled. Now price has no reason to keep pushing in the same direction. This is when you'll often see price slow down, stall, or suddenly move the opposite way. This shift is not random, it's a reaction to liquidity being collected. Just because liquidity is taken does not mean you immediately enter. Liquidity tells you where price went. It does not tell you where price is going next. That's why we wait for confirmation. Confirmation protects you from false moves and fake reversals. Let's walk through the full model step by step. First, identify a clear liquidity level. Second, wait for price to take that liquidity. Third, do nothing, just wait. Fourth, look for displacement away from that level. That displacement tells you the market has shifted. Only after this sequence do we begin looking for an entry. We are not predicting tops or bottoms, we are reacting to confirmation. We're currently looking at the 15-minute chart on ES, and the first thing I'm noticing is that price just had a strong push to the downside. We broke market structure bearish. What I'm going to do first is mark off the London session, since that's the time window I'll be trading in. I'm placing two vertical lines from 2 a.m. to 5 a.m., and I will not be entering any trades until after 3 a.m. One thing I want to mention here is that when it comes to trading, one of the most important things to remember is that it's time before price. I'll be making a separate video explaining that concept in more detail in the near future. Next, I'm using the Fibonacci tool to identify equilibrium. Anything above the 50% level is considered premium, and anything below is at a discount. Right now, price is trading in discount. If we're looking to buy, we want to buy at discount, and if we're looking to sell, we want to sell at a premium. I'll also do a separate video breaking down discount and premium because this is extremely important when deciding where to enter trades. Since my overall bias is bearish, I'm marking off the 15-minute fair value gap and a 15-minute buy-side liquidity that sits in premium. My idea is that if price breaches into that area and takes liquidity, I will look for a sell. However, I will only consider selling if I get proper confirmation or displacement away from that liquidity level. At the same time, I'm also marking off the most recent swing low, which represents sell-side liquidity. I want to see what price does here. If price takes out this sell-side liquidity first during the London session, that opens doors for a potential long, especially if price retraces back into premium or back towards those buy-side liquidity levels. At this point, we wait. Once price starts approaching that sell-side liquidity, I drop down to a lower time frame, the 1-minute chart, so I can look for confirmation. And it looks like we got it. Notice the down close candle and how the next up close candle completely engulfs it. That's the first sign that price is potentially reversing or shifting direction. I then mark off the bearish fair value gap. This is the confirmation I like to use, and I'll go deeper into this entry model in the fair value gap video I'll be releasing next. Once price takes liquidity, engulfs that down close candle, inverts the bearish fair value gap, and creates a bullish fair value gap, that tells me that price is now bullish. and likely wants to move higher to target that buy side liquidity above. So I entered long, targeting the liquidity above. A solid risk management approach here would be to take partials at the equal highs, which would be considered low-hanging fruit or the easier target, and then leaving the runner on for the higher liquidity levels. Once you take partials, you should always move your stop to break even, completely removing risk from the trade. In this example, I chose not to take partials, instead targeting the buy side liquidity directly. The trade played out. I traded 3 micro contracts, risking $562 to make $1,687. The trade took about an hour to fully play out, and in my opinion, making over $1,000 in an hour is worth the patience, discipline, and effort it takes to learn this skill. Now let's look at another example. So in this next example, I'm still trading the S&P 500. We're looking at the 15-minute chart, and this is actually from the same day, just later on in a session. This one is going to be a New York session trade. Earlier, we traded the London session, so from 2 a.m. to 5 a.m. And this time I'm marking off 7 a.m. to 11 a.m. and looking for a New York session setup. Price has already laid down its range for today, and we're still working within that range. At first, price was at the bottom of that range, and we were looking to buy back up into premium. Now I'm using a tool to see exactly where premium is, just so I can understand where price is currently trading. This tool simply splits the price leg in half, showing us equilibrium, which is the midpoint. If price is above equilibrium, then we're in premium. And if price is below equilibrium, then we're in discount. Right now, price is above equilibrium, which tells me we're in premium. And remember, we sell at premium. That immediately tells me that if given the right opportunity, I'm most likely looking for a short. That doesn't mean I'm just going to go short because we're in premium. We still need confirmation. So now I'm marking out the liquidity levels that are also sitting within that premium. I see a swing high located in that area, so I'll mark that off as buy side liquidity. I also see a 15-minute bearish fair value gap located in premium, so I'll go ahead and mark that off as well. Price could retrace into that buy side liquidity level, or it could retrace into that 15-minute bearish fair value gap before continuing lower. At this point, I'm simply allowing the 15-minute candles to print. As price starts approaching that buy side liquidity level, I drop down to the 1-minute chart so I can look for a confirmation, specifically displacement away from that liquidity level. Now, it does look like price is inverting that bearish fair value gap to the upside, and this is where a lot of traders get caught up. But this is how we avoid that. We understand that we're in premium, and we do not buy in premium. So even if price wants to continue pushing higher, that's perfectly fine. That would just be a trade we're not involved in. Buying a premium automatically lowers your probability, and we're only interested in high probability trades. So we don't get caught up in that. We stay patient, and we remember that our job here is to sell. If we see a buy signal inside the sell zone, we do not take it. We wait for a sell signal in the sell area. We wait for everything to line up, and that's exactly what happens next. After waiting, we finally get that displacement to the downside. We get a strong push down that inverts the bullish fair value gap. That alone is enough confirmation for me to enter this trade because we already took buy side liquidity, and now we have strong displacement that engulfed that bullish fair value gap. So this is essentially the same process we used in a previous example. Normally, I would place my stop above the high of the candle that took liquidity, but because this was such a strong displacement candle, that stop would be extremely large. So instead, I place my stop just above the body of the candle. Next, I go back to the 15-minute chart to identify potential sell-side liquidity that we can use as targets. And remember, we do not enter at liquidity. Liquidity is not our entry. Liquidity is our target. So I mark out all the potential targets. The first one is what I would consider low-hanging fruit. The second target is equal lows. After that, we have multiple consecutive sell-side liquidity levels, which are previous swing lows. Normally, how I would manage this trade is by taking partials at the equal lows and then targeting the next sell-side liquidity level. Once I take partials at the equal lows, I move my stop to break even, completely removing risk from the trade. Now let's go back down to the 1 minute chart and see how this plays out. I entered a trade with 2 micro contracts, placing my stop above the body of the candle, and my target is one of the sell side liquidity levels identified on the 15-minute chart. As you can see, price moves down and taps into the equal lows. At that point, I would have taken off half of my profit and moved my stop to break even. For learning purposes, I just left the full position on and allowed the trade to completely play out. And overall, everything worked out well with this trade. In the next example, I'm going to show you an actual live trade that I took. These first 2 examples were done on Market Replay purely for educational purposes. The next one will be a real trade, so you can see it's the same thing. It's the same process, the same understanding. You wait for a liquidity sweep, then you wait for displacement or confirmation away from that liquidity level, and you target the opposing liquidity. Let's move on to the live trade that I took. All right, so in this example, I'm trading micro gold futures. And the first thing I'm doing is marking out my higher time frame levels. I have a 4-hour bearish fair value gap that price is currently trading inside of. And the box you'll see below is a daily bullish fair value gap. Based on this context, I'm looking for a short because price is reacting well off the consequent encroachment of that 4-hour bearish fair value gap. My idea is to look for a move down into sell side liquidity. Right now, I'm on a 3-minute chart, and I'm using an indicator that shows me the 30-minute and 1-hour levels at the same time. At this point, I'm not entering anything yet. I'm just waiting for a liquidity sweep followed by confirmation for a short. If I get a liquidity sweep on a 1-hour, I want to confirm on a 5-minute. And if I get a liquidity sweep on a 30-minute, I want to confirm on a 3-minute. That is what we call time frame alignment, and I'll make a separate video on that in the future. Now it looks like price is starting to approach buy-side liquidity, which also overlaps with a 3-minute bearish fair value gap. So everything is lining up. I also use silver to look for an SMT divergence, and I'll make a separate video on this as well. SMT divergence is when 2 correlated assets usually move in the same way, but one of them takes liquidity and the other does not. As you can see here, silver took out buy-side liquidity, but gold did not. That tells me silver is the stronger asset and gold is the weaker asset. Since I'm looking for a short, I want to short the weaker asset, which in this case is gold. After that, I get my confirmation. We get a strong push down, which is a change in the state of delivery, and that is where I enter my short. My stop is placed above the high that created the SMT divergence. At this point, price started to go into a little bit of drawdown. I'm still confident in the trade, which is why I didn't close it early. It's normal for price to retrace, especially after entry. I then dropped down to the 1-minute chart to look more closely at how price is reacting at the optimum trade entry. If price were to close with a strong candle against me, that would invalidate the trade, and I would exit early for a small loss. But instead, price gave a great reaction at that level. It wicked through it, respected it, and rejected it, which tells me price is likely to continue lower. That gives me more confidence to stay in the trade, even though I'm still in drawdown. If we look at the 15-minute chart, you can see price had a strong push up and left behind a bullish fair value gap. I could have targeted that area for a higher risk to reward, but I just wanted to do a quick scalp and I wasn't really trying to hold the trade for too long. Now you can see price starting to move in my direction. This is the displacement I wanted to see to further confirm my entry. Price displaces through an intermediate term low and continues to respect a fair value gap on the way down. So at this point, I'm noting that this aligns with the 2022 model: liquidity sweep, breaker, market structure shift, and an entry at the fair value gap. So even if you missed the first entry at the change in state of delivery, you could wait for the market structure shift to enter at the fair value gap. Or if you were already in the trade, you could add there. For me, I wasn't looking to add, I just wanted to hold the position. So now I'm just simply waiting for price to reach my take profit. And this was originally about a 40-minute trade, but I fast forwarded down to about 4 minutes for the video. But as you can see, price continues to fall, and there you have it. I hope that live trade wasn't overwhelming. I know I use a lot of terminology that some of you may or may not be familiar with, like consequent encroachment, SMT divergence, and a few other concepts. But don't worry, I'll be breaking all of that down step by step in future videos. Next up, I'll be posting a video on fair value gaps and exactly how I use them when entering trades. If you like this video or if it helped you in any way, please make sure to like and subscribe so I can continue creating more trading content like this. Thank you so much for watching.